The stock market is currently at all-time highs again. News articles after articles are coming out hinting on the next bubble or market crash. Fear and Greed Index is showing greed. Should you buy in now or wait for the next correction? But here's the truth. If you wait for the perfect dip, you might miss decades of compounding wealth. Today, let's break down why markets hitting highs is normal, the biggest mistakes investors make at these levels, and also strategies you can use to keep investing without losing sleep. Markets hitting record highs sounds scary, but that's literally what they're supposed to do. Over the last century, the S&P 500 has hit thousands of all-time highs historically. As you can see from the chart, shows the number of all-time high during the period 1950s to 2020s. Even in recent times, we have seen 104 times where S&P 500 hit all-time highs. So if you only invested when markets were cheap, you'd spend most of your life on the sidelines. So the real risk isn't buying at a high. The risk comes when you panic sell during downturns. Example, if you bought at the 2007 peak, you'd be down 50% a year later. But if you had held your positions until 2025, you'd be up 3 times. And of all the times S&P 500 hit all-time high, there's only a 9% chance S&P 500 is down greater than 10% during a 1-year duration. However, if we zoom out to a 5 years duration, the percentage is 0. This shows that investing at the high, you should have a longer-term horizon, as time in the market always beats timing the market. In fact, investing at all-time highs actually gives similar returns compared to investing during all other dates. With $10,000 invested in the market, if you held that over year 2003 to year 2022 without putting a single cent, you would have $68,000. While missing the 10 best days, your earnings would have dropped to $29,000 instead. And if you missed the best 40 days and above, you would come out negative. This shows that no matter what happens in the market, it is best to not time the market and just keep yourself invested into high-quality names. Here are some strategies that you can adopt when investing. Firstly, dollar cost averaging is a good way to invest a fixed amount of money at irregular intervals regardless of price. Basically, you just continue to buy a certain stock no matter if it is at its high or lows. This strategy will allow you to remove emotion, build discipline, and historically outperforms most of the market timers. As you can see, DCA actually performs well and beats timing high in the long run. The second strategy I want to introduce would be diversification. Don't go all in on one stock, one country, or one sector. Always have a mix of U.S. equities, international sectors, and maybe bonds alternatives. So when one crashes, another cushions you. This would be very crucial, especially if a certain company closes down or have a sharp drawdown in stock prices. If you are diversified, it may not affect you as much as compared to someone who went all in on that stock. Third strategy would be to always focus on quality companies. If you're stock picking, prioritize businesses with strong cash flow, moats, and growth runway. You want to invest in the companies that you can see it growing in the next 10 years. For example, Apple, Google, Microsoft. These companies make money even in recessions, as their products are value-adding to consumers and provide solutions to problems. And last but not least, always keep cash for opportunities. Holding 5 to 10% cash gives you ammo when volatility hits. For example, if you had bought during the COVID crashes or the recent tariff scare news, your investment would have yielded decent returns as market pushed all-time highs weeks after. Think of it as a market crash discount fund. Psychology is everything. The reason why most investors underperform the S&P isn't because of fees, it's because of behavior. They fear missing out at highs, but panic at lows. This makes them buy high and sell low. That repeats until they are broke. The key mindset you need to have is don't invest based on headlines. Have a system or strategy and stick to it. So my take is, if you have 20 to 30 years to invest, highs are just bumps on the road. But if you're closer to retirement, use a barbell strategy which aim to balance out between reward and risk. Basically, keep part of your net worth in growth equities and part of it in safe bonds or cash. The market at all-time highs is not a sell signal, and in fact, it's proof capitalism is working. The real danger isn't investing at the top. it's not investing at all. So ask yourself, do you want to wait for the perfect dip? Or do you want to start building wealth today? If you found this breakdown helpful, smash that like button, subscribe for more deep dives, and drop a comment. Are you buying at these highs or waiting for a correction?